It happened fast. One moment, a record-setting rally. The next, a digital crime scene. The precious metals market was shattered, and the question isn't just what happened, but why. Our investigation starts right now.
So let's look at the first piece of evidence. It's a big one. Gold, the classic safe haven, lost 8.5% of its value. In a single day, the very asset that's built on stability was all of a sudden anything but. And if you think that's bad, take a look at silver. The damage here was, it was way more severe. A catastrophic plunge of over 20% in just one session. This wasn't a dip, this was a total wipeout of all the recent gains. It left traders absolutely stunned.
What we're really looking at here is a textbook whipsaw reversal. A violent pivot from extreme optimism to just sudden, widespread panic. So let's examine the scene of the crime, right before the crash.
You've got to understand, the context here is absolutely critical. This collapse, it didn't just happen out of nowhere. It came right on the heels of a scorching hot rally that had pushed prices to record highs. A rally that was so intense, it shocked even the most seasoned vets on the trading floor.
Every good investigation needs a prime suspect, right? And in this case, the market immediately pointed its finger at one pivotal piece of news, the nomination of Kevin Warsh to be the next chairman of the Federal Reserve.
And here's how the crime went down. The news about Warsh triggered an immediate, really powerful rally in the US dollar. Now, a stronger dollar is like kryptonite for precious metals. It just makes them more expensive for anyone buying with other currencies, and that directly undercuts their appeal.
Now, to really get why the market reacted this way, you have to understand the term hawkish. A hawkish central banker is someone who favors higher interest rates to keep inflation under control. This tends to strengthen a currency, and the market, it immediately priced in a much more hawkish Fed with Warsh at the helm.
Okay, but this is where the case gets complicated. See, when we take a closer look at our prime suspect, that simple open and shut case, it starts to fall apart. The evidence just doesn't add up.
And this is the contradiction that's so crucial. On one hand, you have Warsh's long-standing reputation as a serious inflation hawk. But on the other hand, his more recent public statements argued for the exact opposite, for lower interest rates. The market reacted to the reputation, not the recent reality, and that created a ton of confusion. I mean, why would you sell off on a supposed hawk who's been talking like a dove?
This all suggests that the Warsh news might not have been the sole perpetrator. It might have just been the trigger. Any good investigator knows you always have to look for accomplices, and in this market, there were plenty of underlying conditions that made it extremely vulnerable.
Let's break down the forensics here. First, the price moves had gone parabolic. That means straight up, which is never sustainable. Second, gold's relative strength index, the RSI, was above 90. That's a huge technical red flag that signals a market is severely overbought. Trader risk models were strange to their breaking point. And on top of all that, a record number of call options were basically creating a feedback loop, forcing more and more buying.
So the takeaway is pretty clear. This market was not healthy. It was a tinderbox, and the Warsh nomination, that was just the match that lit the fuse. The market was actively looking for an excuse, any excuse really, to take profits and unwind those dangerously steep moves.
So where does all this leave us right now? Well, with the initial panic over, the market has settled into a really tense standoff. You've got two opposing camps that have formed, and each one has a pretty compelling story for what happens next.
So the bulls, they argue the fundamental story hasn't really changed. They're pointing to tight physical supply, relentless buying from central banks, and strong industrial demand, all creating a solid floor under the price. The bears, though, they fire back that the market is still dangerously crowded, and that if this stronger dollar story really takes hold, the big unwind has only just begun.
And so, the investigation remains open. The violent takedown definitely cleared out a lot of the speculative froth, but that underlying tug-of-war between the long-term fundamentals and the short-term macro forces, that is far from over. Which brings us to the final, pivotal question. Was this crash just a healthy, necessary reset on the way to new highs, or was it the first real crack in a speculative bubble, signaling that the top is in for good? The next